Okay, thanks for joining in, guys. Today I'm talking to Raoul Pal about macro markets and risk. It seems a little bit more controversial than I anticipated, but nevertheless, we're here, and hopefully that makes it a nice, spicy conversation as well. Raoul, are you there with us?
I absolutely am. How are you?
Welcome. I'm very well, thank you. How are you doing?
I'm great, thank you. Can't complain.
Well, that's good. That's good. Look, there's a lot to talk about, and I really want to start with the macro landscape at the moment. I think most of us have not lived in a more complex macro landscape. Where do you start making sense of it all?
So, what I try and do is step back from all the narratives, right? It's a very narrative-driven world these days, and everybody's pushing a different narrative based on their own perspectives, which is fine because these are all probabilistic outcomes and stuff we can't know until things have happened. So, I try and step back and apply my business cycle framework and my secular framework to what's going on right now. So, the secular framework remains to me that debt, demographics, globalization, and technology are deflationary over time. Doesn't mean we can't have cyclical inflation. Now, the question the market's struggling with right now is this a change in the inflation backdrop? Is the rate of change of prices going to continue? Doesn't mean the prices stay the same. People get confused with this. They think, well, if oil's at $100, that's inflationary. No, it's only inflation if it goes back to $200. It has to keep going up. So the question is do we have those conditions in place with all that we know? So what is the predominant driver of inflation? The predominant driver of inflation has been, in my view, the restricted supply of both commodities and other goods and services because of COVID. And that's still working its way through the system. So we can't know yet what we're left with. What does the world look like? So on a probabilistic framework, I defer to my long-term secular framework of deflation. So then what drives inflation up and down in a cycle, in the business cycle, which is the shorter term element? And those tend to last, 2 to 8 years on the upside and 18 months on the downside, generally speaking. What usually drives that is the tightness or looseness of monetary conditions. Now, everybody's focused on the Fed right now. What are the Fed going to do? Now, the bond market priced this in ages ago. So the bond market's already said, 2-year rates are, kind of 3% and 10-year rates are about 3%. The yield curve's been inverted, saying we've got a recession coming. So monetary conditions are going to get too tight. But when I put together a bunch of indicators about what real monetary conditions are, because it's not just interest rates. You've got to think about the rise in the dollar as also monetary conditions. So the higher the dollar goes, the tighter financial conditions are globally because there's less dollars around. And additionally, the rise in commodity prices takes purchasing power away from both companies and individuals. So when you add those three together, the year-on-year rate of change is pretty close to being unprecedented. And it prices the ISM, the Institute of Supply Management Survey, which is the best guide to the business cycle because it's monthly data as opposed to GDP, which is quarterly and gets kind of readjusted later, suggests that the ISM is going to fall from where we are now, 50-something, to something like 35. Now, 35 implies like a negative 3% GDP. So it's a decent sharp recession because of what's happened. It's kind of baked into the cake. And we're starting to see economic indicators suggest the same. Now, inflation is a lagging indicator. Employment is the other lagging indicator. Now, when I look at inflation itself, all the commodity prices have come off their highs. Oil is still the one that's priced higher in terms of where the ISM is. The year-on-year rate of change of most assets actually correlates really well with the ISM, whether it's the S&P, whether it's the NASDAQ, whether it's high-yield bond spreads, or whether it's bond yields. So we found that oil itself is relatively highly priced. So therefore, if the ISM comes lower, which I think it moved shockingly lower very fast in the next couple of months to down 45, suggesting we're in a recession already, then usually inflation over time follows it. So the forward-looking indicators of inflation will start coming off quite sharply and bond yields will start to rally. So I'm waiting for that. I think bond yields have topped, but I need to see those conditions in place. And I think it's only when people start realizing that growth is going to fall. So I think we're in recession. I think it's going to be sharp and pretty nasty, a little bit like 1974. The situation, the current macro backdrop actually reminds me a lot of 1947, which is going quite a lot back in time. But why does 1947? Why is there similarities there? Because back in 1947, World War II had finished, there was no supply chains, and everybody came back into the civilian labor force, very much like a pandemic, but on an even larger global scale. And that caused a massive increase in prices, which then 18 months later went from 20% inflation to negative 6% inflation, then back up again to like 7%, and then back down to negative, and oscillated in this kind of volatile environment as the world grappled with kind of readjusting to the new world. I think that's probably likely to happen this time around. But for that final thing to happen, considering all commodity prices have fallen, is oil probably needs to come lower and stay lower. And I understand the oil market is very tight. So inflation to me from the commodity perspective, looks like it's coming. Wages lag, but we're already seeing layoffs. We're seeing all the tech companies laying people off, and I think we'll see a broader based layoff structure coming, and unemployment will rise somewhat as well, and that takes down the wage pressure, because don't forget, everybody was bidding for engineers or marketing people or whatever, and a lot of that froth is going to come out. So that will ease, I think, the pricing pressure. The final big component is housing. We're starting to see house prices falling and sentiment falling, and the owner's equivalent rent, which is quite a large part of CPI, should generally trend down over time too. Mortgage rates are starting to fall, but we need bond yields to fall with them. So I think we're in this macro turning point right here, right now, where suddenly we go from inflation fears to growth fears, and that'll be confirmed by bond yields falling. Now, what's really interesting is when we step back and look at the asset markets, most asset markets are pricing in different degrees of this. As I said, bonds and oil aren't really pricing it in. Bonds are the most mispriced right now because of this inflation narrative that's so structural right now. Things like the NASDAQ and tech stocks have priced in the most. So, growth end of tech, stuff like ARK, is pricing in, let's say, an ISM of about 39. So that's pricing in pretty much a full deep recession. So there's a lot of indicators that suggest some of this stuff is getting overdone, not probably completed yet. There's probably another down leg, but also that the economic trough probably gets reached sometime around March of next year before we start recovering. But markets discount on a forward basis somewhat of this, not all of it yet. So how does that affect also crypto markets? Well, the macro driver of crypto is two things. One is the central bank balance sheets. If they're expanding, crypto is generally doing well. Now, currently they're contracting, but we're starting to see signs of changes. It's still early days yet, but I expect the central banks to stop trying to tighten their balance sheets and eventually move to loosening as the recession becomes more apparent and the inflation fears recede. The other macro factor that drives crypto is the money supply growth, global M2. Global M2 has been shrinking, and that has taken away the steam from the crypto markets, and it follows it broadly. It's not a perfect fit, but it's a pretty good fit. So basically, you need to see money supply growing. Now, what's good is we've got forward-looking indicators to tell us about money supply, and it's actually the inverse of ISM. So what it's telling us is going forward, the probability is the money supply globally starts increasing, and we're already seeing the signs of that in China, where Chinese M2 is coming up, and I think we'll see it elsewhere as, for example, the European banks start to struggle a bit, and so money supply starts increasing. So I think we're at the macro inflection point. I think bond yields fall over the next, we'll look back in 2 months' time, and bond yields will have broken 275, which is the floor, I think, in 10 years, and be heading down to 2%. That's very similar to what happened in 2018. The bond market, the Eurodollar market, the short end of the curve is already pricing in rate cuts for January. So the market said, you're going too far here. The yield curve is inverted. but the whole trade sets up as soon as the yield curve starts steepening, which is generally when the bond market starts rallying. So there's a lot of information there, but generally the big view is we're at the cusp of the turn. I think that's what the crypto markets are picking up. The crypto markets are very forward looking. The tech stocks, the growth end of tech, those things bottomed 2 months ago as well. And I think that's telling us something, is that there is still a probability of new lows. But I think on balance, like 60% probability that the lows are in of growth tech and the lows are in of crypto. Of the rest of the markets like the S&P, I don't think so. I think we've probably got another leg lower to come, but crypto and tech will outperform. So that's my view in a nutshell.
So you mentioned commodity prices have started coming down again. Have they recovered prices from before the Russian invasion of Ukraine? How do you see that factoring in going forward? Or do you think that's largely the global markets have sort of absorbed and adjusted to that? And second component or second question is, with inflation, there's a counter narrative that says inflation is here to persist. What's your understanding of that argument, and why do you disagree with it?
Yeah, so firstly, yes, most commodities are now gone below the kind of have got back to like the pre COVID levels. So they've unwound the Russian levels. Things like, there's the Economist with the front cover of global food shortage. Meanwhile, wheat's been plummeting. So most commodities are down somewhere between 20 and 60%. As I said, oil's really the outlier here because of the tightness of the oil market. Now, the oil supply is still in the market. So Russia's just moved its supply elsewhere. So we've got structural rigidities because Europe's not getting as much supply as it needs, but Russia's selling it elsewhere. So the market is still tight. There's still not enough oil, but I think demand is weaker than many oil market participants believe, and that we've got a demand shock coming. And as the demand shock comes and GDP falls, then oil will come down with it. So generally speaking, I think the commodity story is over for now. Can it resurface again in a year and a half's time? Well, that's the story of the sticky inflation. The sticky inflation is the story of, okay, what happens if we can't get commodity prices down? Now, commodity prices generally are disinflationary. Crop yields go up year in, year out because new technology allows us to produce more crops per acre than we ever did before. And that trend's been, yes, it's been slowing, but it's still in place. So technology is driving that, and that's why we've seen crop prices come low. And I started an agricultural hedge fund at one point because I had the thesis that it was going to go much higher until I learned that was a wrong view, painfully. So the idea is that the people think structurally it's here to stay because of deglobalization, that there's onshoring of activity. So people are going to build factories in the United States and in Europe as opposed to having them in China. I think that's certainly probably true. I also agree that the commodity markets will remain tight for some time because there's underinvestment. But the question to me is the year-on-year rate of change going to be going up, or do prices just remain high? Now, the year-on-year change going up is what generates inflation. I'm not sure we can really generate significant inflation. So my base case is actually inflation goes negative in 18 months and then recovers somewhat back to a normal cycle level. What that means, I don't know, whether that's 3% or 4%, at peak inflation at the top of the cycle, at the top of the business cycle, possibly. But there is a risk, to my view, that maybe I'm wrong and inflation comes down from 9% where it is today, gets down to 6%, stabilizes here, and then 6% inflation is persistent. I mean, that's a pretty ugly world. I get the arguments. I just think it's difficult to do. And I also think that, generally speaking, if you look at things like, Elon Musk building car factories in the US and Germany, what he's doing is using robots. So as you move the manufacturing back, you're replacing people with robots, which is deflationary. And we can see that in most places. So the robots are taking over the world along with artificial intelligence, and there's pretty much nothing we can do about it because as technology improves, the cost of that technology collapses, and basically everything that's digitized goes to zero in cost over time. There is another structural element, which is the ESG element. So the ESG element is, the forcing of adherence to ESG mandates and investment by the European investment community. I think that's like a fiscal super cycle over time. Let's see what the governments do. They'll probably use the recession as a chance to supercharge that narrative as well. So I think there's probably a bubble to come out of kind of green energy plays, because Europe's basically said, okay, we are going to have to move away from this faster than we thought. And therefore, Europe, I think, will incentivize even more for companies to start changing and for new technologies to be developed. Now, that kind of narrative can create issues for things like the copper market or the lithium market. I get that too. But that is piecemeal. Now, don't forget, we had a massive demand-led inflation in the 2000s, from like 2000 to 2008, driven by China. So as China came onto the world stage, it consumed enormous amounts of resources. There was a massive demand shock for the world. Commodity prices exploded, but inflation averaged 2.5%, 3%. So it's not clear that inflation is the big thing. You can be a commodity bull, and I think coming out of this, you can probably be a commodity bull and a technology bull at the same time. I don't think it's an either or situation, but I don't think that prices rise and stay high at a rate of change long enough to create persistent long-term inflation.
I do think that the situation is very different to when China was consuming all those commodities. For a start, the supply chains have supposedly broken down, and for whatever reason, it seems to be nigh on impossible to get them back up and running again. Has that situation changed? Do you anticipate it being able to change fast enough to avert more supply chain issues, also perhaps economically as well?
Yeah, I used to be a real kind of doom and gloomer on a lot of stuff until I really understood technology and the incentive system behind it. And if you've got supernormal profits being driven by problems, structural problems like supply chains, it is a race to solve them because you capture the supernormal profit. So that's how shale came out. Shale was a technological advance that was revolutionary, that was driven by high oil prices. The $140 oil led to the shale revolution, which led to oil coming back down again, which is why commodity prices tend to be cyclical over time and not structurally higher. And so, yeah, I think the incentivization for this is higher, and also think that supply chains changing may actually be more efficient in the end. So by having less distance traveled, you have less friction points along the way. And if you've got less friction points along the way, sure, the overall level of prices may remain slightly higher because it's slightly costlier to use, let's say, European labor than US labor, or North African labor versus Chinese labor, or whatever it is. Yes, they can remain higher, but again, it's not high commodity prices that cause inflation. It's the rate of change. And even with yeah, go on.
Unusually, I think it's not so much the uncertainty in the medium term and long term. I think a lot of trends are fairly clear, but rather from a more acute time frame that there's so much uncertainty.
For sure. I mean, I wrote a tweet thread about this. It's one of the most uncertain, complex macro environments, as you led this conversation with, that any of us have ever lived through. And so there's a lot of probabilistic outcomes. So, I think it's very difficult to ascertain, okay, what is the correct narrative and how persistent is that? The markets generally lead us in the right direction because it's a discounting mechanism by millions of participants. So generally, over time, the markets price this correctly. Now, if inflation was structurally higher, then 5-year break-even rates would be higher than where they are. They're still flirting with, breaking back down below, where are they now? They're at about 2.6%. So 2.6%, that's not very high. That's implying basically that we've got slightly positive real rates, and we've already broken the system with it. So I'm not sure how different this is going to be to other cycles, but I absolutely concede that it's very difficult to get a very high risk reward on it. I'm thinking bonds are about the best risk reward in the macro world right now, but I'm open to being wrong too, because this is a really complex environment.
Well, it seems that, just take any issue in the markets or macro, there seems to be very credible people taking diametrically opposed views about even something as simple as inflation, whether it will persist or suddenly become disinflationary. And as someone who's not a macro expert and doesn't invest his time and energy into analyzing all of those factors, it just feels like, and very probably, that any one of those factors goes the wrong way to what you might expect, and suddenly the whole landscape changes. So if inflation suddenly is not contained, that just changes everything else. All your calculations for everything else, markets, interest rates, real estate, unemployment, everything else suddenly is a different calculation. So I'm finding it really, really difficult to come to terms with that. But it does seem to me that everyone is sort of settled on, well, what the Fed needs to do next. And my understanding from listening to you is that you seem to think the markets have pretty much done the job of the Fed. But when I listen to the Fed, it seems they're hell-bent on continuing to raise. At least they're signaling in that direction further. And they're watching unemployment as their key measure to see if something breaks. What's your take on that?
Yeah, I think they're always behind in the narrative. They're always, by definition, behind the curve because they follow what the curve is saying. And the curve is saying you can probably get to 3% and then you're going to start cutting. So they want to do it because it's a political decision in this day and age as well to make sure that people don't lose trust in the Fed, because if not, you lose trust in the monetary system. And people are already a bit shaken by what happened. And so, but the bond market itself is saying, well, you're not going to get any further. And the moment you do it, you're going to have to start cutting. So the bond market's pretty good with that kind of stuff. And it's writ large in the Eurodollar curve. Now, can it be wrong? Of course it can. But it doesn't feel like it is, because this is the largest monetary tightening pretty much in all history that's already happened. So the Fed are just kind of nudging up rates to go what already 2-year bonds priced 9 months ago. And that's the issue here. I mean, none of us borrow at Fed funds rate, not one of us. We all borrow based on the bond market itself, which is, 2-year rates or 10-year rates, whatever we're doing, whether doing a mortgage or getting a loan. And so that was already priced. I mean, we've seen it in everybody's mortgages, right? This is one of the largest rises in mortgages in all history. So that's already happened. Whatever the Fed do is irrelevant now. And the inverted yield curve tells us that the most likely outcome is that yields come lower as the yield curve steepens. I mean, I was just rereading The Alchemy of Finance by George Soros, where he goes through not a wildly dissimilar period of 1984, 1985 with the very strong dollar that led to the Plaza Accord. And Soros just drops one line of nugget of quality info. He's like, the best time to buy bonds is when the yield curve's inverted, because that's forward looking and suggests a recession is here, and the next part of that is yields come lower. And that happened in 1973, 74 too, and that was in the period of supply disruption of the Arab oil embargo. We still saw bond yields fall as the economy, I mean, ISM went from 56 to 30 in 4 months, the fastest collapse in ISM in history, as the Fed had tightened conditions and the oil market and inflation bit. Growth collapsed, the markets collapsed, and bond yields rallied. So, yeah, I don't know.
What's the one thing that you think is on the horizon? It's on the landscape, but it's not in play yet. That could wipe out all of your analysis.
China, yeah, China invades Taiwan, or China really does something large to disrupt supply chains on a basis that we haven't yet seen. Okay, that's a huge problem the world could not deal with. I don't think China can do it to itself right now because its economy is super weak. They've got a massive problem with debt overhang, this aging population, and growth issues, and they've still got the COVID issue. So I think China would be the scary thing. If China invades Taiwan, because I think it's a good point, because the global economy is weak and the US is on the back foot where they split, political divide. If they did that, okay, all bets are off. If Russia ups the ante in a way that we can't yet comprehend, that probably has further effects too. So geopolitics, I usually discount geopolitics because usually it's just a lot of people with no knowledge claiming they have knowledge, and it's usually a waste of time. But we are clearly in a global polarization where we're going to be splitting the world into different places, and this stronger dollar is going to drive that narrative. But I think it's probably driven not initially by warfare, but driven by economic need to move away from the US dollar, because the US economy is 25% of global GDP and something like 87% of world trade. So the dollar is everybody's problem. The dollar is screaming high and nobody's got enough dollars. So, we're starting to see a lot of emerging markets coming under pressure. That's a big issue. It's a big issue for the European banking system too, because they're, big participants in the Eurodollar market. So I think a rising dollar, if it goes shockingly further, I think right now it probably corrects for a bit, and then we've probably got another big push over the next month or two before it settles down for a while. But we need to be careful, because if it really overshoots, then the Chinese, the Brazilians, the Indians are just going to go, enough. We just don't want your currency, and we're already starting to see that, and that's been underway for a period of time where the Chinese are trying to move away. Now, obviously, they want the advantage of it being coalesced around them. Who knows what the outcome will be, but that's something to keep on the radar screen.
Interesting. Let's talk markets. And I want to start with, you mentioned the dollar. So the DXY, much has been made about the inverse correlation with the Bitcoin price. How do you look at the DXY? What sort of signals do you take from it? Why do you think it's so high? I think the last time I checked, it was very high. Why do you think it's so high? And do you think there will be a catalyst for it to turn around, or is it just stronger and stronger from here?
So I think as the world got more and more in debt, and more of that debt was in dollars, and because this over-reliance on the US dollar, we've got a global game of musical chairs. If you withdraw liquidity from the dollar funding markets, which is what the Fed are essentially doing, you're taking away a chair. The first person who collapsed on the floor without a chair was Sri Lanka. But there's more to come. So you've got this scramble for dollars in environments like this that drive the dollar higher. The dollar has something called a smile. Now, the dollar smile is observable in times of strong growth. The US, with its tech-heavy kind of entrepreneurship, has tended to attract more capital than other countries. And so that has led to the dollar to go up. In times of kind of regular GDP growth, money goes out the risk curve into emerging markets, and we see the dollar go down. Then in periods of stress or tightening of monetary and liquidity conditions, we see the dollar go up. But if we're not careful, we can create a huge feedback loop where the dollar just keeps going up and up and up, which is what happened in 1984 and 1985 that ended in the Plaza Accord. Now, the dollar is the single most important macro variable because it's basically the denominator for all trade. And so it destroys margins, it destroys economies, and is a really big deal. So that's why it has to be on everybody's radar screen. Now, if you quote the price of Bitcoin, you quote it in dollars. So the rise of the dollar, ceteris paribus, leads to a fall in the price of Bitcoin. Now, it's not a perfect relationship, and it is not persistent over time, but on balance, it has a negative impact. Now, as I said, I still think the dollar rises a bit further. I think it corrects for a few days or a week or so, and then we have yet another push as the euro pushes through parity, into the 95 cents range. Dollar yen keeps going a bit higher as the Japanese keep printing money to buy Japanese government bonds in a process called yield curve control, and emerging markets have a bit of a freak out, and I think China needs to lower the value of its currency. So I think that's still to come, and that's not going to help markets at all, and it may create a pullback in crypto from this kind of current rally we've been in. Could it break through the lows again? Possibly. I think unlikely, because I think we're at the tail end of this larger dollar move. Now, God forbid if we're not. If my technical signals fail on the dollar, on the DXY, and we start pushing through and get to 120 or so, or even breaking 120, then we've got a world of pain to come. But that is also very deflationary, because all goods are going to come in at much cheaper prices. So
what do you think that would be a signal of if the DXY just kept shooting higher and higher?
I think it's an issue that the Fed have gone too far, and they've just taken too many dollars out of the system, and that nobody can cope with it. And the geopolitical issue that rises from it is it kind of forces China, Japan, and a whole bunch of other people to say, listen, we don't want your bloody currency. Your currency going up and down is our problem. And we need to have something else. Now, that would be the seeds of a decoupling of global trade from US dollars, where people are forced into it because they just, I mean, the South African economy, or, why the hell should they deal with the dollar all day if their main trade partner's China or India? But yet they do. And that can't persist. Now, obviously the Chinese would love it to be the RMB, but the problem is the RMB is non-convertible. So they have to come up with some solution. I don't know what the hell that is, but I've talked about this for a long time. I think there's a new Plaza Accord to come, whether it's in this dollar bull market or the next time around, because the conditions for the dollar to fall over a sustained period of time are not in place and have not been in place for a decade now. So I've been a structural dollar bull since 2012. And when I was in Europe, I was writing Global Macro Investor. It was priced in euros. I changed the pricing to dollars, took all of my savings, stuck them in dollars, and forced myself to hold the trade by buying property abroad in the US and in the Cayman Islands at the time, to make sure that I didn't trade the position, because I had a structural view that this was going to be a problem. And that view continues to play out to this day, and I don't think it's done.
And so we arrive at the SPX and NASDAQ, famously correlated to the Bitcoin price. Well, a lot of people make that assertion, actually, but it hasn't gone unchallenged either. How do you see that?
So correlations in markets are passing when it's a macro variable that's creating them. The macro variable right now is liquidity and inflation, and liquidity and inflation has driven all further out growth assets. Because if you think of Bitcoin is essentially a network adoption model which has a high volatility because there's less certainty around it versus, let's say, a utility company. So what you've got is something that has more risk versus the inflationary outlook. So that's why things like ARK Invest and Bitcoin have pretty much traded in line. They've also kind of traded in line with bonds. This is all the same macro variable. But once you zoom out and look at what drives crypto over time, it's non-correlated, because it's driven by both network adoption over the longer run, and it's driven by the debasement of the central bank balance sheet by the printing of money via QE. Those things seem to be observable as a long-term secular trend. Now, we could argue that the central bank don't expand their balance sheet again, but does the network adoption of Bitcoin and the crypto markets in general disappear? I think that's a very, very low probability. So therefore, over time, it doesn't have to look like technology. But if you think about the technology stocks, why do they look somewhat like Bitcoin? Well, because most of those are network adoption stocks. We're in a period that I call the exponential age, and that's a period of a confluence of technologies all at the same time, all racing up the adoption curve, all having Metcalfe's law at the same time, creating something called Reed's law, which is network effects on top of network effects. And we can include blockchain technology in that. We can include AI, robotics, Internet of Things, EV, space. There's so many of these elements, genetic sciences, that are all coming together at one point that we've never seen in history. So this is the fastest rate of change of technology in all human history we're gonna face, and it's gonna be a very difficult period for humans to get to terms with how fast technology is adopting. And that's why these tech stocks, particularly the growthier, less uncertain, earlier in the network adoption, look very much like crypto, because it's all part of this meta narrative of the future of technology and the future world that we're going to be living in.
And so when we come to understand, or when we look at risk on and risk off, it seems like we're all at the starting blocks, or are we even in the starting blocks waiting for the Fed to start the firing gun?
So my view is we are. I think bond yields topped last month or the month before. So I think that was thing number one I was looking for. Thing number two I was looking for was the oil market to stop going up, and it fell significantly. It's obviously having a rally now. Let's see whether that creates another new high or not. My guess is not, because demand is being destroyed. So therefore, we've got two big factors that have been weighing on technology and crypto out of the way. Crypto, we had the liquidation event. So normally when we have a liquidity withdrawal by the Fed, you get a liquidation event. We had a big one in crypto. So that feels like, okay, that monetary tightening has now washed through the crypto markets and is less prevalent. So could we get a further risk off? Yes. Are we going to break the lows? Not clear. Again, probably not, but it's possible. And again, I kind of give it 60-40 odds. And so why are we seeing this in crypto, and why are we seeing it in stuff like ARK, which bottomed 2 months ago? Because again, their job is to be forward-looking. Their job, because these are the most forward-looking of all parts of the financial markets, and they are doing their job, which is they are starting to say, hey, listen, maybe the euro-dollar market's right, and the Fed are going to change course, and liquidity conditions will ease somewhat, and therefore they can rally. They don't need a rate cutting cycle. They just need inflation to die down somewhat, and also for inflation to die down, forward-looking growth to be going up, not down. And again, they discount it early in advance, and for rates to stop rising. So I think that condition is fine to find a base. And then if rates start coming lower and financial conditions start easing, then these things will be off to the races. And that's generally my view in that.
Raoul, when I came into the Bitcoin space, you were a Bitcoiner, and then you became a Bitcoiner with a bit of ETH, and then you became an ETH holder with a little bit of Bitcoin, and then you completely disavowed Bitcoin altogether. So, personally speaking, what happened? What happened to catalyze that directional move, and then to make the complete move over into altcoins instead of where you had started when I was entering the space?
So it's nothing about the philosophy of Bitcoin that people like to think that I've changed my mind on. It's nothing about what I think the future of Bitcoin is, which I haven't changed my mind on. You know, I wrote the first macro strategy piece on Bitcoin, I think ever published back in 2012, 13, and I've maintained that view. But my job as an investor is not to have my philosophy rule my investments. Some people can, and that's okay. I have no issue with it. But what I started to do was understand, okay, what drives the price of Bitcoin and what drives the price of digital assets overall? And that's when I started digging into Metcalfe's law and network adoption models. And I realized, okay, now I've got a pricing framework for this stuff. So then I started doing the work, and I saw that the ETH network was growing faster. And it's basically about volume, dollar volume transacted on, let's say, a monthly basis versus the number of active addresses. And ETH has been outperforming for a significant period of time in terms of the vibrancy of its network. And I looked at the chart of the cross rate of ETH versus Bitcoin. It looked like it was going to break out. So I started dipping my toes in. As soon as it broke, the ETH chart itself looked great. So I started thinking, well, if I want to get allocation, I believe in Bitcoin. I believe in blockchain. I believe that Bitcoin has a massive role in the future of the global monetary system as a global store of value over time. I think its technology is revolutionary, but ETH is another technology that's built on top of the same kind of ideas, and it was going to outperform. Simple as that. Nothing to do with philosophy. And what happened obviously was more use cases were accruing to ETH. Now, can that change over time? Sure, I don't have a problem with it. So it's nothing to do with philosophy. It's to do with trying to maximize the returns in what is probably the greatest opportunity for investment and wealth generation we've ever been given. And I maintain that view. So my view maintains that I will adapt if I see opportunities for creating excess profit. So things like NFTs, they become interesting because they're actually call options on ETH. Because over time, if the ETH ecosystem does well, more money piles into NFTs. NFTs outperform ETH itself. And so therefore, you've got the basis of ETH going up and the basis of NFTs going up. Now, I also think ETH is flawed. And ETH is flawed because it is too slow, it's too expensive at times, etc. So that drives people as I talked about before, same with commodity markets, to start looking at the opportunity set and saying, well, we can develop something different. So that something different ended up being things like Solana and Avalanche. Okay, great. So they're cheaper and faster, but they trade off decentralization. So everything is a trade-off versus Bitcoin's decentralization. And some people require the decentralization above all things, and others require the utility above all things. So what that did was drive different parts of the space as blockchain technology became almost ubiquitous for the future of technology. And so the opportunities for me now, I'm not a stock picker, I'm a macro guy. So I'll never have, a ton of, I don't trade really, I just buy this stuff and hold it. And occasionally I'll switch my allocation from one thing to the other. So recently I bought I sold some of my ETH and some other tokens and bought more Solana. So that's my second biggest bet right now. And could that change over time? Could I be wrong? Sure. But I'm not a big trader of alts. I just bought a basket, equally weighted basket, because I said I think the whole space is going from a market cap of $1 trillion to 200 trillion or so. So if I just hold a basket of stuff like, Aave, Uniswap, just stuff that is, on a macro tactical allocation basis. I want a bit of DeFi, I want a bit of layer ones, want a bit of layer twos, blah, blah, blah. And let's see how it goes. So that's how I've approached the space, and people always think.
So you said that you're not a stock picker or you're not a trader,
Correct.
but I do have to push back on that, because at times you do use the language of a trader, and it does seem to me that you're making recommendations of, excuse me, moving funds in a similar fashion. For example, through the overall cycle, I remember you were saying something about there's no reason to own Bitcoin because alts have a higher beta, and during the bear markets you want to own stable coins.
Yeah.
How do you still abide by that, and how do you think that's held up so far in the bear market?
Well, I think that's been pretty much the right assumption, because if it's a bull market, then you want to own beta. The hard thing is, it's easy to make as a flippant comment. What beta do you want to own? That's the hard part, right? That's the stock picking part that I'm not particularly good at. Hence why a basket, and my current view is that ETH outperforms Bitcoin over a period of time. So I kind of stick with that because it's a deep ecosystem. So it's a macro bet as opposed to a micro bet. But some people are amazing at the micro bet. It's just not my game. But I observe stuff, and I'm very interested in learning about new technologies, new opportunities to see, is this a place you can allocate capital to or not?
But it was more than that. I think a key plank to that thesis was the ability to earn yield. And famously, your comment, basically risk-free, has kind of come back to haunt you. Well, what have you got to say on that?
I've always made it absolutely 100% clear. I have never generated yield ever in my life. I don't like yield. I'm a macro guy. I don't give a shit about it. So I don't think you ever get compensated for the percentage yield you get for the volatility in the underlying asset. I've always maintained that. And anybody who's known me for my 30-odd year career knows that I've never cared about carry or yield. But some people do.
I followed you closely, and I haven't heard you emphasize any of the risk associated with it. And when you use terminology like basically risk-free,
people need to,
that affects a lot of people.
Yeah, great. People need to understand the actual next sentence of that piece that people cut. And that next sentence was, if you want to own that asset, all yield comes denominated in something. Now, if we want to be absolutely accurate here, the yield was paid out until the ecosystem collapsed because it was a DeFi-driven yield that occurred. The problem is the underlying token went to zero. It's exactly the same with a local currency bond. A local currency bond like Argentina, the local currency bonds almost never default. Why? Because you can print your own currency. So if you want to own that ecosystem, then you are prepared for a yield. Right now, the US government bond market that we've been talking about is actually a US dollar thing, right? If the US dollar collapses and you get paid, 3% yield, then the underlying has gone down. But if you want to remain in the dollar, then you'll take it, which is why ETH is actually quite a big deal here, because it is the second largest cryptocurrency, and it will have, and again, I'm going to use the term because people need to understand it, risk-free yield, because the staking will give you the yield. And that staking doesn't go away. It's mechanically part of the construct of the smart contract. So it all depends whether you want to own the underlying currency or not. It's the same with every single bond and every single yield in every single instrument in the world. The difference is CeFi. CeFi is an artificially generated yield that is not, that doesn't come without default risk because you've got counterparty risk. That's a whole different game. There is no counterparty risk in most of the DeFi ecosystem. In CeFi, it's artificially generated yield, an artificially generated yield by people who are borrowers and lenders. So it's basically a pseudo bank. And if they don't have good borrowing and lending analysis and understanding of the risk they're taking, this shit happens, which has just happened, I've seen it time and time again in the traditional financial markets. That is not the same thing as a DeFi-driven yield that is basically guaranteed by the protocol level. And again, it's all about, do you want to own the underlying asset or not? And people cut off that part of the video because people don't want that narrative. They want to say, oh, Raoul said good and yield and Luna went to zero. 1, I've never owned Luna. 2, I've never understood it. 3, I said later in the video, we also need an app that gives us a rating of where these 20% yields come from in terms of risk. And that's true too. And there's nothing to do with that. Now, I think ETH staking is going to give us the, again, inverted commas, risk-free rate for Web3, which is the largest protocol's yield. Now, is it entirely risk-free? We don't know, but nor are US government bonds. But let's say we do, then we can start pricing stuff with spreads over ETH, like we do with every bond market in the world is priced over US treasuries. Every single form of lending, including credit cards, is based on that. And that's what we need to get to so people can understand yields without screaming and shouting at somebody when yield blows up. There is no such thing as a free lunch.
Well, there's a further point to be made, I suppose, is that sometimes an ecosystem, that the entire underpinning is the yield, essentially. And it's not because someone didn't pay out the yield that the ecosystem actually collapses.
Correct.
But the yield is the actual honeypot. And so when we have quotes from you that I've always said that I'm a big fan of the Terra Luna, Terra ecosystem, that acts as an endorsement for a lot of people, and they treat it as such.
Have you ever had a trade go wrong on you? Now, I didn't own it, never owned it. I have a full documented track record for the last 18 years, longer than almost anybody in the entire business. So I can prove that it's never been a recommendation of mine for anybody. But have you ever had a trade go wrong?
It's not a question of being wrong. Of course I have. It's not a question of being wrong. What I'm trying to get at is, do you acknowledge that you got it wrong? Do you acknowledge that the language...
I didn't own it. You're misinterpreting and putting words in my mouth as if I'm recommending...
No, I'm not. I haven't put any words in your mouth.
I've not recommended
These are
anything.
Verbatim quotes. And what I'm saying is that...
they're not verbatim quotes, my friend.
They are literally written in black and white, quoted from documentation. I can send them to you afterwards.
Which one?
I can send them to you. So what I'm quoting you right now is that you said, I've said it repeatedly, I'm a big fan of the Terra ecosystem.
Yeah.
Yeah. And so that gives the appearance of an endorsement. And whether or not you actually buy it. Do you not
say that about Bitcoin? Do you not say that all day about Bitcoin?
Raoul, I think I'm being fair in allowing you to speak. Just let me finish my point and you can have all the time you like to answer me. So that is perceived as an endorsement, and kind of like if this was a political race, whether or not you voted for the person is moot if you've actually endorsed the candidate, and that's the appearance that it gives. And so that's what I wanted to ask you. Do you take responsibility for that language?
No, because I have full documented track recommendation. If I say Ethereum, yes, because I own Ethereum. I've got my money behind Ethereum. I have trade recommendations documented in Ethereum. Same with Bitcoin. So you can observe things. I can observe Apple and say it's an amazing company and Apple falls 50%. I can still have that opinion, but it's not a trade recommendation. And if we want to do that, then everybody talking about Bitcoin, and it's now gone down 70%, gave a trade recommendation that was terrible. No, that's not how it works, my friend. That's not how it works at all.
I would stand by the words that I've used in support of Bitcoin.
But I've not supported Luna. It's your interpretation, my friend.
That's exactly what I'm saying, that the words that you've used give the appearance of an endorsement.
You know what? If you go back to my Twitter feed since 2013, there's thousands of endorsements in that perspective then of everything from currencies through to bond markets, through to single equities, through to the economy, through to commodities, thousands of them, because it's actually my job to comment on financial markets.
I agree that it is your job, and
So
I
shall I not say
really
anything in
value.
case I'm wrong, or is that
No,
does that add value or take
that's
or
not right.
detract
That's
value?
not what I'm saying, Raoul. You know that. What I'm trying to impress upon you is the responsibility for what we endorse.
I don't. Okay, we're going to argue over semantics about whether I endorse Luna. Find something I've endorsed that's gone wrong. I'll own it all day. I'll
So
own my
what would
ETH
amount to an
calls.
endorsement from you?
Fantastic.
What would
My ETH calls. Perfect example. So I got really bullish from my work on ETH, and I thought, you know what? We've got a probability of an advanced breakout to happen in ETH. I bought ETH calls with 5% of my capital. So I transferred my ETH into Deribit, bought ETH calls because that is a defined risk reward, and then put it on Twitter to explain that I had bought ETH because I'm very bullish on it, and I bought it via calls because that gives me a structured, risk reward. And then people are like, you bought it at the top. Yeah, no shit, Sherlock. Of course I bought it at the top and got it wrong. But I had a defined risk reward. And I don't see a problem with that. And financial markets I've had thousands of trades that have gone wrong and thousands of trades that have gone right. It's just part of markets.
Part of markets. I think the nature of the volatility in this industry, and particularly with the prevalence of scams, leads people to be hyper vigilant about the sort of language that's used to seemingly give an endorsement of one project or another. And so, you are in the business of giving advice and research. You do have a position as an authority, at least from a macro perspective, and you've pivoted into also doing research in crypto as well. I think that comes with a certain gravitas. And with that, maybe, I don't want to assert upon you responsibilities you don't want to take, but perhaps there does come with it some kind of responsibility about how you're perceived, how your language is used, and how it's perceived by other people as to whether or not this is an endorsement or not. Now, my understanding, listening to you, is anything short of a buy-sell recommendation is not an endorsement or disendorsement.
Or I own this.
Yeah, I don't think that's how a lot of people perceive it, though. I really do think people.
I've got a million Twitter followers. I cannot manage the psychology of a million different people.
We're not talking about managing the psychology at the margins, though, are we? We're talking about a general perspective, a perception that was created by you saying things like it's basically risk-free. I think people are taken in by things like earning a yield because they really don't understand the differences that you've just outlined. You are a sophisticated investor. You do the research. You understand the differences. But I think a lot of people, they just see a percentage yield and they just go click and accept and they don't know what's going on.
Did I ever write those words? It came in one video where I was talking about the rise of DeFi. So it's not like I've been writing about stuff like this and pushing it as a narrative. So it was, and you know what? The other interesting thing is I get a lot of correspondence from a lot of people. Not one person said, oh, Raoul, you got me into Luna. It's been a fucking disaster. Not one. The actual people who did that was the Bitcoin community.
Why do you think that is?
Because they think they're the global policeman of what is right and what is wrong, and they don't like people to own anything but Bitcoin, which I think is not a fair narrative. Now, all financial markets are free markets and people should be free to choose the risk that they choose to take. Now, if that's a risk above and beyond that of Bitcoin, that's fine too. We are in a financial markets game, whether we like it or not. We're not in a philosophy game. That's not what plays out on the screen all day. What plays out on the screen all day is risk and reward.
So I agree with that. And I think people need to take personal responsibility for their own actual financial decisions and the trades they enter into as well. I'm not averse to people holding others to account to some degree, but I do think there's a hypervigilance that's unhealthy as well, to the point where everything can't be a fucking scam. Everyone can't be a fucking scammer. It borders on the ridiculous sometimes. But I think also we need to have the presence of mind to reflect upon the use of our own language, myself included. I'm not just directing this at you. Was I too bullish? Was I egging people on at the height of the market? Am I projecting my own personal circumstances and risk-taking appetite, and putting that out to 1 million people and unduly influencing their risk appetite as well. This is something that I need to do more of, and
Archie,
that's the line of questioning that I'm taking with you.
Archie, you and I are just humans too. We're just humans, right? We all get too bullish at the top, too bearish at the bottom. We all get things wrong, all things right. There is no holy grail. There's nobody who is right all the time. And once people just accept that, it's a much easier world to live in. That I don't deal in certainties, I deal in probabilities, and I make that clear in almost everything I ever say. And I think you probably do in your own mind too.
Sure, I don't hold you to that standard whatsoever. Otherwise, I wouldn't be talking to you right now. I'm much more open-minded than that.
But that's what I'm saying. It's a really difficult job as humans, right? Just at a human level, not what you should, could, but it's what we do. We're just humans. We're just trying our best to figure it out like everybody else. And people have to realize that. Yes, we come with more experience. Yes, we also get it spectacularly wrong. Yes, sometimes we can get it spectacularly right. But we are, after all, just humans. And as is everybody else as individuals who follows us for nuggets of information, analysis, or counter-analysis, whatever it may be, that's okay. It's a big global melting pot of people who are trying to figure it all out together. And within that, there's a bunch of Bitcoin bears who've been killed over the last 10 years by being entirely wrong about it. Are they being irresponsible? No, they're just wrong.
So what's your big takeout from this DeFi collapse with Terra Luna, Celsius, BlockFi, and the like? What do you take out from that?
Well, it remains always my same view on yield is I don't like yield. I've never liked yield. I do think many more projects will go to zero, and some projects will be absolutely enormous, and that's fine. And I've always dealt with this space as if it's a kind of VC-like space. Hence why I've had a broad basket of stuff, because I don't really know, because there's so many unknowns when it comes to something new. My general view for people is yield is enticing, but it comes with risk. So if I say, as a risk-free rate, again, in inverted commas, for Web3, does ETH work? Yes, but you get locked up for a fucking year. Where's it? ETH if you need it. You can't get your ETH out, and ETH could be down 80% again. So it's simple as that. Is you just have to understand that anything that you already accept enough volatility in the space to capture the rewards, and it's a risky space overall because there is failure risk of networks, and therefore does a 6% yield or whatever the number is of what ETH staking yields will be, does that counteract it for you? Now, for an institution, it might do. They'll take an asset allocation and say, I want this trade for the next 10 years, and therefore, if I can accumulate yields, I'll do it. I've never done that. I just don't like it. I just don't like it. Even if I can understand where the yield is generated and think it's relatively safe in terms of yield in that underlying currency, I just prefer the liquidity. And you've seen that liquidity issue. It's been really interesting to watch. And stuff that happens in swap markets and financial markets is what happened was staked ETH traded massively below ETH itself. And that was because people had staked ETH and then wanted the liquidity to be able to get out of their position. And so it trades at a discount. Liquidity has a premium in markets like this. And again, you think you've got something, but you've actually got something else, which is staked ETH in Lido was not, doesn't trade one for one with ETH, obviously, because there's a different mismatch of liquidity between the 1 year staking and the ability to withdraw your ETH.
Yeah, I think we're in alignment on yield. It's just not worth it for me, particularly when it comes to like if the company actually loses it, your collateral is gone. It's dead. And I also like the fact that you mentioned it's venture capital risk that you're taking with alts. I don't know if you agree with this or not, but holding Bitcoin for me is not the same level of risk profile as holding a basket of goods in the alt market. I think it's a very different risk profile. I wouldn't liken holding Bitcoin to VC risk at all, whereas I very much think that it's way up on the risk curve to hold alts, even a basket of alts.
Yeah,
I'm interested in your thoughts on that.
Yeah, because network failure of Bitcoin is now pretty much infinitesimally small. So therefore, we've lowered the risk, the existential risk of Bitcoin going away. Now, we still had it in 2017 when I first sold the Bitcoin I bought in 2013. I sold in 2017 during the forking wars because I thought this is existential risk, and I sold too early. But I think there is no existential risk of that sort, i.e., questioning the chain itself and its ability to survive. So therefore, it is lower risk, and it's observable in the market because the market attaches a lower volatility to Bitcoin because the network has a higher adoption rate than any other of the blockchain networks, and it has a lower observable volatility than all of the others, and that makes absolute sense. And ETH is probably next because it has a deep and broad network, but it's not fully adopted as Bitcoin is, and there's still an existential question around the ETH2 merge, right? I think probabilistically it works, but there's a chance. And if it doesn't work, they may have one more shot at it before ETH may have a big problem. And I get that too. Now, I'm prepared to take that risk, but I understand it's an existential risk.
So before we wrap this up, excuse me, I'm struggling with the cough actually. Before you wrap this up, is the bottom in? What are you looking for before you gain that level of confidence? Are you fully invested right now? And what are you looking for before you fully invest if you're not already?
Yeah, I mean, as I've explained to people, again, people get confused when I say, well, I'm adding to my position. They're like, well, but you're fully invested. Well, I've got an income. So what I try and do is capture excess savings and then stick it all into the crypto markets, so again, I have virtually no savings. I'm pretty much entirely in crypto. So
so am I.
Yeah, and I'm comfortable with that risk, right? Because I've got an income and I'm comfortable that I can not worry about that money for periods of time. Now, sometimes you might want some of it, and that's okay because it's a liquid market and you can get some of it out, which is, again, one of the reasons I don't like the staking as much. So I've got a small amount of cash sitting on exchange that I was hoping that we were going to get the last bit. I've been averaging in with everything I've got, any penny I can find over the last 4 weeks, because I had every single technical signal that I needed. Everything from the long-term regression channel, which I quote a lot in Bitcoin, getting pretty much to 2 standard deviations oversold, 2 standard deviations oversold in alts and Ethereum, to whether it's the Bitcoin ribbon or the ETH ribbon, or whether it's the DMARC counts or the RSIs or the on-chain activity, or all of the confluence of stuff gives a probabilistic framework that we are either at or around the low. The price action.
That's what I think as well. But I see analysis from a guy like Bury saying, okay, well, that was earnings compression. Now it's, earnings compression. Now it's up to multiples compression. I think, holy crap, have we got another 50% to go?
Well, I'm not sure that equities and crypto won't decouple. So, again, it was observable that the equity market reached new lows and stuff like ARK didn't, and nor did crypto. So I don't think they're entirely correlated. And again, because the crypto market is more forward looking. So I do expect equities to come lower. And that might stop this rise that's going on in crypto right now. And we could get a decent gut check pullback. We could even retest the lows or whatever it is. I don't really know. And again, I'm giving odds, I think, of 60% chance the low is in. So that's not really strong odds, but I'm comfortable enough that if it falls lower, then if that's over the next few months, then I can get a bit more cash, I can add to it, but I'm as comfortable as I've ever been. This feels as good a setup as I've ever seen, and I've been in this market. And again, you can, Twitter can then shout at me and say, well, he told me it's the low. I mean, it's a fucking stupid game. But, I've been in this space since 2013. This is as good a setup as I've ever seen.
Yeah, I agree. It's
but
everything I'm looking at.
But to go back to the conversation we had before, Is that perceived now to be irresponsible if it falls another 50%? See, this is the nuance and the difficulty of the lives we live being financial market participants or crypto market participants. Here's you and I saying, you know what, we think it's likely. And then in 6 months' time, somebody puts this clip out and says, see, they were getting people in and it fell another 50%. They're irresponsible. There is no winning.
I think when we're discussing market risk, it's distinctly different when compared to something like yield, which is almost barefaced fraudulent within the crypto space. And really, the risk that we were taking there, we're talking about very, very different things. Principally, there's no difference, but in essence, there is absolutely a massive difference. In my view, I think there's a massive difference.
Yeah, don't know, because in the end, you still own the underlying protocol. It was the protocol that went to zero. So people owned the wrong protocol and it collapsed.
People don't make that distinction, really.
No, but they need
I don't
to.
think they do.
It's really important that people start to learn that it's not just money. It's not magic internet money. It's based around.
It is, Raoul. It is. That's how they see it. They just see it as a number on a screen, and they see no difference between making a few clicks and sending money between checking and savings accounts, and making a few clicks and putting money into that Terra protocol or whatever. They don't see the difference.
I actually disagree with that one. I think the CeFi one is a much bigger deal. So that one, it's so fucking difficult to do. To figure out how to go to Anchor and how to do this and how to do that. You know, I just don't have time for it. But, you know, I'm sorry, but when you've got these CeFi companies with lots of glossy advertising and here's a yield, we make it like a bank, that I have bigger issues with. I have real issues with how yield is generated. And every time I've interviewed any of those people, I'm like, where are you generating the yield? Oh, it's lending and borrowing and this and that. Yeah, and then in the end, it all ends up being one customer, which is 3AC, and the whole kind of house of cards comes down. Doesn't mean.
But that was insane. How do they give them unsecured, 500 million or whatever? How do they get that money? I want some of that.
I've seen the same. It's exactly the same as what happened with long-term capital management. It's exactly the same. When you become everybody's biggest customer, you get the best terms in the street. And when you get the best terms in the street, and you think you're onto a no-brainer, and everybody believes you're the smartest people in the room, it self-perpetuates until it falls apart. I see it.
So have they got
endlessly.
loan sales people within those organizations who are incentivized to sell debt or sell out loans? Is that how it works?
Isn't that what every bank is?
Yeah, I wonder if these newish organizations operate on the same principles, because, you know, they're quite young and the demand seemingly is already there. Do they really need to push out there? Do they have so much money in their pockets that they need to have a sales force to push it out there? You know, I wasn't sure of that.
I don't know whether it was the chicken or the egg. I don't know if they sold a product that didn't exist and then generate the demand from 3 Hours Capital, right? So everybody's got this self-perpetuating cycle of which it's the wrong way around, as you're kind of correctly pointing out. I think that's more true of stable coins, where it's the right way around, which is there is demand for stable coins and that generates some yield. Now, stable coins have their risk too, and everyone's acutely aware of all of the different risk spectrums of stable coins. But I think that is the case with stable coins more so, but less so with crypto protocols because they're so unused, really, most of these things. They're so nascent that who is the user? Who is generating the yield?
Mm-hmm. I don't know how people have the courage to actually give their money to somebody else who says, if I lose it, it's gone.
Well, you know, I lived in Europe in 2012 when we almost lost the banking system. And that's what they did. They said, basically, Cyprus, we woke up one day, I was living in Spain, and the Cyprus banking, all the banking systems were going down the toilet. And the EU said, sorry, guys, we're going to bail in the banks. What bailing in the banks mean is exactly what's just happened in CeFi.
Taking your savings, yeah.
Is you take your savings when you should be separated. And then Europe put in this 100,000 limit. So basically, you can only have 100,000 in a European bank without being completely exposed to a credit event. So you become a creditor, not a depositor. And again,
85 grand in the UK, I think. Yep, absolutely.
And that's why I got into Bitcoin to begin with, for exactly this reason. Because I saw this and I realized that there was no safety. Because I went to set up the world's safest bank And then I got introduced to Bitcoin in 2012, and I thought, actually, this is the answer we need. And that was my whole start of the crypto journey, was realizing that in a bank, you are actually a creditor.
Raoul, I want to thank you for doing this. I know there was a lot of pressure on you. I did know there was a lot of pressure on you. I was feigning ignorance. And, sometimes it's the best thing to be able to have these discussions. I know that I lost a few hundred followers because just the mere thought of talking to you was anathema to them, which I just find completely and utterly anti-intellectual and bewildering, that even the prospect of a discussion, not the discussion itself. For all they knew, I was going to interrogate you for an hour, but just the mere prospect of a discussion elicited such strong vitriolic responses in my replies. I can only feel sorry for these poor souls that they cannot stomach a mere conversation.
And I appreciate the hard questions as well, because I think it's important to air these things out properly. And I have no issue with that. And you let me have my say. We may not have agreed on how it played out, but the point being is, we can all act like grown-ups and talk to each other, and it's a much better world when we do, when we understand everybody's perspectives. We don't have to agree with them all. And I really appreciate you doing this.
Yeah, well, if we didn't have this discussion, if I wouldn't have been able to ask you those questions. And
Exactly.
Look, this is not a court of law. I'm not trying to prosecute you, so I don't know what outcome people were expecting from a discussion like this. But there are some things we certainly disagree on. But I'm glad to have had the opportunity to get your point of view out there. And thanks again for doing this. I appreciate it. You're welcome back anytime.
Thank you, my friend. Yeah, the leaving thing is, the world is much more nuanced than anybody expects. We see the world in black and white, but it's basically a massive spectrum of grey. But good luck to everybody. It's a complicated world out there.
Thanks, Raoul. Cheers.
All right. Thanks, my friend.
Bye.